All right, that's 12 sharp. Thank you, everyone, for joining. We're here for another, market discussion or market update, and just wanted to take the opportunity, thinking every 6 to 8 weeks, just to touch base and look back at the previous 6 to 8 weeks, and also look forward. A lot going on in the world right now, and I know a lot of people have questions about how that impacts their financial lives. So whether that's from their investments to their spending and cash flow and budgeting, want to make sure that we touch on all of these things and make sure that if you have questions, you have an opportunity to reach out and chat with us and see if we can answer them off the top. And if we can't, always certainly happy to get back to you. So it is going to be Michael and I presenting as soon as I get the slide to flip over. We've got a great history of working together now for a number of years, and thought it'd be good for the two of us to come on. So
awesome. Thanks, Peter, and hello, everyone. A little bit about Continuum 2 is we do adopt pension style investing. What is designed to do is to focus on long-term and sustainable growth, right? We're going to look at different asset classes, diversified through manager styles, and also geographically. This way, through all market conditions, we are built for your specified time period to weather all storms and cycles. And then at Continuum 2, we take a lifelong student approach. So both Peter and myself, we are continually focused on getting new designations, getting the continual education on our current ones to make sure that we can always best service our Continuum 2 clients.
So why are we here today? I'm going to look back 2022 in review, and then looking forward. So in 2023, what are the experts saying? What are the economists saying? What are the different portfolio managers saying? And these are sort of the key highlights that we're seeing. So inflation, interest rates, housing, employment numbers, tax change updates, and is there this recession looming that we've been hearing about for a long time? And then ultimately, we want you to come, and spend your time with us to walk away with well, what does this mean to me? Or how do I use this? So how do you handle all this? And then first home savings account coming, just a brief touch on that. And then just, focus on 100% of the time, market drawdowns are followed by growth. I know when you're in the middle of those drawdowns, it can be hard to believe it. And, it's always important to look back and see that it happens over and over again.
Yeah, so looking back at 2022, we were in a bear market where we saw both the global stock market and the Canadian bond index down in double digits. That is usually a rare correlation, but what does this mean, right? There are two things for investors to keep in mind. And the first one almost sounds like a contradiction. Stock prices were down, and a large part of that was due to interest rate hikes. However, these interest rate hikes that caused lower returns are also the reason why there's future prospective positive returns. How this works is if interest rates are at 0%, and you know what? There's always a risk wanted for taking, or a premium wanting for the risk on stocks. So interest rates are at 0%, and we're expecting a 4 to 5% return on stocks. That seems pretty favorable. But if we're now able to get that 4 or 5% on interest sitting on cash, that 4 or 5% on a stock doesn't seem so enticing anymore, because you're taking a risk to get an equal expected return. So because of this when interest rates grew, that meant that there's a safe haven. So people were now leaving the stock market to move to cash because of guaranteed returns. So with that risk premium, when you buy lower on the stock market, now this enhances the positive returns on it. So if we're now expecting seeing 7, 8 plus positive returns, now people are willing to buy back into the market because that premium is back on the expected return on stocks, where before there wasn't that return.
Yeah, Michael brings up a great point. It's interesting. For years, I'm 20 years in the business now, and all this time I've always talked about risk-adjusted rate of returns, and a lot of clients and even advisors we find don't focus on risk-adjusted rate of returns. They're just looking at returns in isolation, and that's a huge mistake in our opinion. You really need to look at what's my risk-adjusted rate of returns? How much risk am I taking on to get that return? So again, looking back, so if we're looking at 2022, this is as of December 30th. So looking back year to date, so for that entire year, last year, You can see some big negative numbers. NASDAQ on that tech world down 33%. You can see S&P 500 down 18, MSCI World down 16. If you go to the bottom, again, Michael mentioned already, very rare for equities and fixed income to be down together. But you can see that long-term bond index was down 21%, corporate bond down 9%. You can see gold was up, down 0.3%. So really interesting couple things. One is the two being down together. Two, when you look at your portfolio, I don't think we have a single client, anywhere in the neighborhood of even minus 20s or, minus 16s, minus 18s, when you look at that diversified portfolio. And that just speaks to our pension style investing and why we build the portfolios that we do and why you want to be diversified across the board. The gold I find very interesting, and I've talked to a number of clients about gold. And when we look at, all of the corrections that have happened in the past, especially the major financial ones, and 2007, 2008 is a great example. Like if gold was ever going to shine as that sort of safe haven, that would have been the time. And we found it didn't. And same thing happened, with COVID, is that you would think that when there's, so much uncertainty happening in the world, that's really the time that gold's going to skyrocket. And again, it didn't. But what I have found is that the industry, unfortunately, the gold industry, they try to capitalize on those when they make money. So you see gold hitting all-time highs, whether it's $1,700 or $1,800 an ounce. And guess what? Now you start seeing ads for now's the time to buy gold, which I can tell you it isn't. In 2000 is when I started really tracking, the markets. I had done my Canadian securities course in 2000, and gold was around $270 an ounce. And you look where it is today, and inflation, it really hasn't grown like it was expected to.
Yeah. And so if we look at the chart here, we see that the Toronto Stock Exchange was down nearly 10% last year. And although it weathered the storm better than majority of global markets, still not fun seeing that negative 10%. But if we look at the same chart over the past 5 years, we see over 32% growth. And we see there's multiple periods of declines, especially looking at 2020, which is a very drastic, sharp decline. And we're already back above those returns, even with a secondary drawdown since then. So this just goes to show that, as we will continue to say and preach time and time again, it is all about time in the market, not timing the market.
Absolutely. The most important thing is when you need to get out. And again, when we're building portfolios, we always have those conversations of what's your goal and what's your timeline. And that's exactly why. So if we look at 2023 so far, actually been very, very strong. I mean, you look at what's happening around the world, there's still uncertainty. But one thing with the markets to always try to keep in mind is they're forward looking. So they're actually looking at what's going to happen over the 6 to 12 months that's coming versus over what just happened. So there's certainly, some optimism, I would say, and we're going to go deeper into some of the portfolio managers that we've reached out to and companies that we've reached out to. But when we look at what's happened so far, you can see we're up 6.54%. Now, this was as of January 27th. And it looks like we're off to a good start. And obviously, we hope that this continues.
Yeah, so what we did was, is that we're not economists, but we went out to many of our partners, McKinsey, Fidelity, BMO, talked to their economists, their portfolio managers, and saw, well, what are their thoughts for the year ahead? And through different opinions, different analysis, they all drew to relative parallel conclusions. And for McKinsey, theirs was expect interest rates to remain higher for longer. Central banks, their actions, it will slow economic growth globally. There's an opportunity to make significant returns in a high quality bond market, right? For the first time in over a decade, interest rates are in a relatively high level, and there are returns to be had on the bond market. And then there are folks on signs of inflationary pressures easing as much of the heavy lifting has been done. We saw these massive shifts from 0.5 to 4.5 on the interest rates. That was all to curb inflation, and a lot of that heavy hitting is behind us, and there's not going to be these aggressive changes going forward.
So then we reached out, and we have a response from Fidelity here. You can see we have from their chief investment officer as one of the portfolio managers. And, one of the big themes that we see going forward is this monetary tightening is behind us. So when we look at, monetary policy, that's really, the government spending and how they're spending and where that money is going. And when you look at tightening or loosening, they're basically either trying to get the economy to grow or get the economy to slow. So up until now, with inflation, the way it's been, they've been trying to get the economy to slow down. And that's what monetary tightening is. Focus on profitability is really when, again, we're looking forward and we're looking at, the companies, and when they're looking at what are the value of those companies, really it's going to come down to how profitable they are. We're going to talk about this when it comes to the employment numbers as well, because I believe a lot of the tech companies that are doing the layoffs, that's exactly what they're trying to do. They're trying to right the ship before, the recession hits, or before, the threat of recession, because they want to look like they're profitable companies. And guess what? A great way to do that is lay a bunch of employees off. And, we look at where are we going when we see Jury and Timmer, choppy sideways markets. I think that's to be expected when we look at 2022. There's still a lot of uncertainty. There's not a direct path, in any one simple way to say like, yeah, here's where we're going and here's the answer. So I think, that's going to be expected.
Yeah, now looking at Deloitte, they had their reports more focused on the real estate market and looking at how the housing market is going to drastically have an impact on our economy. The housing market is typically lagging indicator, which means we see the impacts after the cost has occurred. And we're going to see that big loss in Ontario and BC, largely because we are the most heavily reliant provinces on real estate, and we have the highest prices in the country. There are job losses. They are expected to remain low during a predicted recession. The main losses we're going to see is going to be in the construction industry and IT, as you see by the mass layoffs from Facebook, Amazon, Apple, Google. The IT sector usually leads the way when it comes to the growth sector of either growth or contraction. But history shows that adding risk halfway through a recession is actually beneficial long term when you're creating value, right? Think of it, right? Stocks are on sale. If the markets are down 20, 30%, they might go down another 10%, but eventually they have to get back to parity and beyond. So if you can weather that storm just a little bit longer, then that's where the heightened returns will come. However, Deloitte does believe in that, like I said, as we were saying from Fidelity and McKinsey, that the recession looking like it might be mild and short-lived. We're not looking at another 2008 scenario like originally feared. But the inflation should decelerate sharply, and we actually won't see the impacts of these interest rate hikes for another 1.5 to 2 years. It takes that time period for interest rates truly to feel the impact. Think of someone who mortgaged himself to their neck in 2019, 2020. They're not going up for renewal until 2023, 2024, or 2025 even. So now they already mortgaged beyond what they should have been able to handle. They're locked in for 4 or 5 years. Now they're up for renewal at 4% higher. Their interest, their mortgage payments are going to go drastically up. Now we will see the impact of what these interest rates are going to cost. It's not felt yet in the market. There is still more time for it to take a hit. And that's why Deloitte believes there will be rate cuts through 2024 to allow more of a modest recovery, and then a more robust one in 2025, where the full impact of these interest rates will be behind us by 2025.
Yeah, that's a great point, Michael. When you think of monetary policy again, when we look at that interest rate, that's kind of like their main lever, if you will, or their main tool for controlling, what's happening in the economy. If they bring interest rates down, that spurs growth in the economy, it spurs spending because money's cheap, right? On the other hand, if they're increasing interest rates, then that's trying to slow it down. So when we look at if we are going into a recession and if things do start slowing down, they're going to have to start cutting rates because they don't want that to continue. They don't want to cripple the economy. They want to slow it. This is to Michael's point, that sort of the full effect takes from 1 year to 2 years. And it's really interesting because people are making decisions today on cash flow today, but things are going to get worse. So it's really important to think and keep that in mind when you're looking at homes, vehicles, renovations, large durable goods. So whether it's appliances or furniture, these are all things that are big ticket items, big spend items. And if you haven't felt the full effect yet, but you're making decisions on that today, it's something to keep in mind. And that's sort of one of the big takeaways we want you to have.
Yeah, and if we look at interest rates all the way back to 1954, we're still now it's at 4.5 now from 4.33, but we're still relatively low historically, and actually lower than we were in the last Great Recession. It's like, look at the chart from the 80s, 90s. Pretty much, I think everyone in their 40s, 50s talk about interest rates at that time. And mortgages were at 12%, 16%. We're still at 4.5. Your mortgage might be at 5-6% of that. So as much as it sucks compared to what you were getting at 2-3% a couple of years ago, or even last year, we're still historically pretty low. And if we've already hit that peak and hitting a decline from that point, even slight, we're still in relatively a strong position compared to historically.
And I think this is such an important slide just from the consumer sentiment. And you hear that a lot, consumer sentiment. But if you think of yourself right now and how you're feeling about the economy and where the world is, that's consumer sentiment, right? Most people feel we're in a really, really difficult, terrible position right now. And why I love this slide so much is look back. I mean, it's been significantly worse many times before. So when we actually take stock of where we are today, our feelings might be, oh, wow, it's really bad. It's terrible. It's never been this bad. It's been way worse. And we're going to come through this just like we've come through every other correction. So when we look at one of the big issues, and, I've been really focused on the housing market, my concern around the housing market for years now. And, it's interesting. Most of us have now heard of FOMO, fear of missing out. And I just find it incredibly fascinating that, human nature is that when prices are at all-time highs and transaction numbers are at all-time highs, is that this is the time when people feel they have to jump in. And this is the time where it's like, I got to get in now or else I'm never going to get in. But what's really interesting is that if you actually look at the world and how the world works in terms of cycles, so whether it's the stock market or the economy or forest fires or locusts, everything happens in cycles. They go through boom and bust cycles. And, the housing market is now going through that correction phase. But if you actually think back, 12, 18, 24 months, the fear of missing out was such a huge thing. It was such a motivator to make people, jump up and be like, oh, I got to get into this house now, or else I'm never going to be able to. And unfortunately, those people are getting bit right now, and it looks like it's going to continue to get worse.
Another stat we're looking at is employment numbers, right? So if we look at it, it seems like a very contradictory point right now where we have very low unemployment rates, but we're seeing massive layoffs on a weekly basis, right? So keep in mind that these employment rates are national wide, right? Well, the layoffs, as you mentioned earlier, they're primarily in tech, and we might start seeing it in construction, right? Especially as home price decline, there's worse consumer sentiment towards it. So developers, even though there's a housing supply, they're going to hold off on all their properties. So if they're not going to hold off on their releases, they're not going to end up having new houses to build that aren't released yet, and that's going to slow up the construction industry as well. So these are the things that we want to keep in mind when looking at recession. Is as much as interest rate and inflation is super important, employment numbers and the unemployment rate is also a key stat to keep a look at.
Absolutely. So the changes that are coming, new taxes on home flipping, this actually isn't new. They're just making it, I would say, more official. Home flipping has been something that's been on CRA's radar for a very long time. There's people that have made significant amounts of money from flipping houses. Now they're going to definitely be watching significantly more than they have in the past. And you can see there, basically if it's within that 12-month period that you bought and sold a home, they're going to be watching. You have to report selling your principal residence on your tax return now. And that profit, which, principal residence up to this point has been kind of no matter what tax-free, certainly have to be concerned about being taxed on it now. New taxes on vacant housing. This is really looking at foreign buyers coming to Canada and, taking up our sort of housing liquidity and buying houses that Canadians otherwise would buy and driving prices up. So really, reducing our supply and increasing prices. So they're looking to tax that. I think this is, a great move. And if you have, people from other countries that think Canada is a great place to invest, hopefully they still do. And now they're going to pay a tax to have the privilege of owning a house in Canada. And this is going to free up some capacity for Canadians to buy.
Yeah. A couple more positive changes on the tax hikes is usually tax changes come with a negative connotation towards it. Is the introduction of the first home savings account. This is a now tax-free vehicle for first-time home buyers, where they can put up to $8,000 per year over a 5-year span. So that's a maximum of $40,000 in contributions. And they could pull those contributions out plus the growth on a tax-free basis for their first home. And unlike the tax-free savings account, these are actually tax-deductible contributions similar to an RSP. And you can actually use this in conjunction with the RSP first-time home buyers plan. So that's now a total of $75,000 where first-time home buyers have access towards tax-deductible contributions. And now you take them out either tax deferred on the 0% interest loan for the RSP plan, or completely tax deductible and tax-free withdrawals on the first home savings account. Keeping up with increasing house prices, this really helps first-time home buyers get in the market with an additional savings vehicle. Just a heads up, as much as the government introduced this plan, on the CRA side, they've not figured out how to administer it yet, so they are not open yet. We're in communication with our mutual fund dealer to see when we can get these plans going, looking minimum spring, but it might continue to get dragged on until CRA can figure out how to administer this in the back end. But hopefully this change is coming and coming soon, so it is a great news. And the tax-free savings account for all citizens 18 plus, they have a new additional contribution room in 2023 of $6,500. When the last couple of years it was $6,000, so at least we have that additional room to contribute as well.
CPP and EI deductions, they are on the rise. It's still a question we get often. I would say, CPP in particular was likely unfunded like in the 80s, like a very, very long time ago. I still get asked today, and people make comments today about, well, it's not going to be there when I need it. It's going to be there. I mean, they've actually made CPP incredibly strong. They continue to fund it and, really, as you can see, increase the funding. And this has been actually a number of years that they've been increasing it every single year. And that's going to continue. I think, if you look in the middle there, that $305 more, for some households, just important to keep in mind. Again, that's going to hit cash flow, right? So reducing your take home.
Yeah. So as Peter mentioned in the beginning is, well, what's the takeaway from all this? We talked about 2022, and that's in the rearview mirror now. We looked ahead to what we can expect in 2023, but again, nothing is guaranteed. So what does this mean for all of you, right? Now, the recession is not guaranteed, right? It may not hit home to you personally. It may not even hit at all, but what are some measures that you can take into your homes now that can prepare you in case this recession does hit and does hit you personally? One is if you can find a way to reduce monthly spending. And I know everyone probably just gave me a dirty look with their bills going up on inflation. If you went grocery shopping over the weekend, you know exactly what I'm talking about. But we're talking more about incurring new monthly expenses, right? If you're already struggling with mortgage payments, cash flow's tight, don't send a new lease for a new luxury car, right? Maybe add a home equity line of credit or a second property that you won't be able to afford to carry if you lose a tenant, right? Reduce debt wherever possible. You will be renewing mortgages at higher rates if you have one. Loan interest rates are going up. I know a lot of people have that kind of argument of, do I pay down my mortgage or invest it? Typically, our approach is to pay down that mortgage first, now more than ever, right? At these current interest rates, that interest you pay is guaranteed, whether it's 5, 6, 7%. Your expected returns on your investments are exactly that. They're expected. They are not guaranteed. So if you're able to reduce your debt, please do so. Also, hold on to your job. There's a lot of job flipping right now. Because there's a lot of updated salaries in the market. We're getting paid 20, 30% bonuses to move. Well, just remember, if you have job security now and you move to a new employer and they're not as forward thinking and they need to make job cuts, you were the last in, you're going to be the first out. So don't compromise your job security right now. Also, cash is king right now. I know the last few years we're talking about cash is dead because of no interest rates. Right now, again, you're able to earn 3, 4, 5% on non-locked in cash. Additional, it's if you're renewing a mortgage and your cash flow is going to be tightened because of increased rates, or you lose your job, big expense, right? You need to do a new roof. It's going to be significantly more expensive than last time you got that roof done. So keep extra cash. If you typically keep 3 months extra, keep 6 months right now. Just the whole point is be a little bit extra conservative right now, because you don't know yet where the domino or the puzzle pieces are going to fall. So just make that fortress and protect yourself as much as you can.
So yeah, my number one concern going forward for sure for 2023 is the housing market. I think you've picked up on our sentiment. Really the worst has yet to be felt. And I truly believe this. I think there's a lot of people on the sidelines for the spring market thinking that's going to be sort of their holy grail to, make their money and get out of the house that they can't afford and get out of those mortgage payments that are too high. And if you look at this, affordability index, it's off the charts. You see that it's just like not sustainable. Like there's just no way Canadians can maintain the current level of housing and pay the rest of their bills. So what does that mean? That like we're going to be forced into a correction. And like I was saying before, like I don't care what the market is, I don't care what the economy is, I don't care if it's stocks or bonds or GICs or forest fires. I mean, things always go in ebbs and flows or ups and downs or cycles, if you will. And like we're really, the housing market is correcting, and we see that and we hear it now. But I believe it's going to get worse because people haven't felt the true impact yet. So I want everyone to kind of be prepared about that and know what's happening for the year to come.
Yeah, and if we look at increased monthly payments, they take time to impact Canadian wallets, right? We keep saying it takes 1.5 years to 2 years for any real field interest rates to hit. Look at the charts here. We see that same rough graph lining as the prior one, where monthly payments have skyrocketed. Every utility bill, any bill you could think of has skyrocketed, probably well above that 7% inflation you're seeing on news reports, because that only encompasses a small basket of goods, right? Where we bring that out, the real inflation to your personal wallets is probably hit a lot harder than 7%. So again, this does add to perspective on housing affordability, because as your other monthly expenditures go up, it also will impact your housing affordability as well.
So take the long-term perspective. I mean, that's absolutely going to be a consistent theme that you are always going to hear from us. And the reason is the stats, the math, and the data all say that's the right thing to do and prove that it's the right thing to do. So again, it goes back to when we're building portfolios, it's about understanding needs, goals, and timelines, and making sure that we have that nailed down when we're making investment recommendations. And important for yourself is that, when you look at where you are today and where you want to go, is it short term or is it long term? As you can see from this chart, going, all the way back to 2008, stay in long enough and you are going to be rewarded. That's, critically important to understand. But if you need money quickly, that's when you need to be adjusting your investment allocation.
Exactly. Further to that, it's all about perspective, right? I find the financial side of investment is only one piece of the puzzle. The psychology is just as important when we look at that consumer sentiment, right? It goes to the same market cycle. Markets are going up, people get confident, and then they have that fear of missing out, so they keep buying more and more. And that relates to that euphoric feeling where essentially we get a little bit too arrogant. We feel like, oh, we got to buy now, it's going to go up forever, can't lose. We start seeing a small decline, and then we hit denial. And now, we hit a 20-30% correction, and people are panicking, sell now, sell now. Meanwhile, they were the same people 6 months ago talking about now's the best time to buy. Understand this psychology, have that long-term approach, and you'll see by this chart, last chart, and almost any other investment chart you will see is that over time, markets go up. It's just a cycle that every market, again, whether it's bonds, stocks, real estate, what goes up must go down, but it also must go back up. And that's the key thing to remember over the long term. And that's why when we build the portfolios, it's for your timeline, right? You're not going to be 100% in stock markets if you need that money in 2 years. It's going to be heavily focused on preservation of your funds to not see that drawdown. So again, understanding your timeline, your psychology of an investor are two key components of what risk you want to be willing to accept, if any.
Such a great, important point, Michael. And I can tell you over the 20 years I've been doing this, I've had a number of clients reach out and, just Peter, like, what do I do? Like, do we just stay in? And then I tell them all the reasons why, yes, we just stay in and why we have your portfolio designed the way we do. And Penn just telling us, and they said, I knew that's what you're going to say, but I just really needed to hear you say it. And don't beat yourself up. Like, it is emotional. It's your money. Like, we take this seriously, of course, when it's our own money, and you can get panicked and worried, and there's nothing wrong with that. But we encourage you to reach out. We want you to touch base with us. And that's a big part of working with an advisor, is making sure that they're that sort of steady hand and take the emotion out of the equation and make smart long-term financial decisions rather than short-term emotional decisions. Why do we diversify? We always love this chart. We've shown it many times. but you just look at sort of the cycle, and the question always is do you see a pattern? There isn't. And you can see that, in 2022, the Canadian equities specifically were actually up 5.8, whereas pretty much all the other categories were down. But you can see like how that's changed over the years. You can never pick, so just make sure that you have a well-diversified portfolio and you're participating in all of it.
Yeah, and one thing, no, on that Canadian equity, because I know we showed the TSX chart earlier. TSX is only a certain basket of Canadian stocks. That's the top, pretty much every company listed on the stock exchange, which isn't tracked in the same way as the TSX. Just so that's why you see the different numbers there. But like I said, ask us questions. There's an email, a call. We can answer. We'll have a question period for this conversation. We are here anytime. We don't need to wait for full review meetings or these webinars to discuss. If there's something on your mind, feel free to reach out to us, and we're happy to chat anytime.
I'm going to stop the recording now. So if there's any questions, people can feel free to ask questions without the recording being sent out after. We are going to send this recording out. So if you want to share it with anyone, you can feel free to do so. And thanks so much, everyone. We really appreciate you joining and taking the time to be with us. And based on your feedback, like I said, we'll look to continue on with updates like this every 6 to 8 weeks.